We can kind of make that into a spreadsheet, but I will leave that stuff for next time. Let me kind of show you what sort of spreads are there for certain bond types. Getting this summary information is a lot easier if you go to fredstlouis.org. Fred is short for Federal Reserve Economic Data, and St. Louis Fed actually houses that. You can get all sorts of data from here, but I'm going to look for example, double A option adjusted spread. Then what we mean by option adjusted spread, even though I'm not going to cover it in this class, there are a lot of corporate bonds that have built-in options like callable, puttable, and that sort of stuff, or convertible, those effective valuations. These are spreads adjusted for those options. This is basically the market interest rate for that bond minus the uh, interest rate for treasury bills of the similar maturities. Currently for AA bonds, which is almost no risk, it's 72 basis points. And AA's are important. By law, pension funds can invest only in debt instruments of issuers that are rated AA or AAA. That means you can get about 0.7% more compared to treasuries of similar maturities. I mean, in tough times, these go up. For example, if you look at the last 5 years, come on. Yeah, when the COVID lockdowns happened, because of the fear in the market, they went as high as 273, but they're typically not that high. About a year ago, they were 95 basis points. They're much lower now. And in most cases, when market thinks that economy is going to kind of tank a little bit, these spreads tend to go up, but there isn't that much of an indication. You can look at the single A. Or let's do this. Let's do a simple one. T-bill rates 5%. Oh, 500. I just want to do a simple exercise. At what probability of default I would get a spread of 0.72? This is a very, very rough analysis, but okay. So treating those AA bonds as one period numbers, this basically says expected probability of default, assuming 50% recovery ratio, is only about 1.36%. Okay. Now let's look at the single A. That's 0.99. So if I did the same thing, so it's only 179. Let's look at BBB, which is the lowest level for investment grade ranking, 154. About 289. So the lowest investment grade bond has a roughly 2 times the default probability of AA. Let's look at the single B. Anything below triple B is considered junk bonds, and single B and double B are the only ones that would get any trading. For single B, 442. That means if you invest into one of these bonds, on average, you would get about 4.5% more than treasury bills of comparable maturity. So here's what that means. This is assuming 50% recovery ratio. That's about 8%, okay? That's about 3 times as much as the lowest grade investment grade bond. So the higher is the probability ratio, the higher is the default premium. That's pretty much the idea. On Wednesday, we're going to extend this to a distribution of values for the recovery ratio, because there is actually a distribution to it. And B, we will kind of start looking at multi-period cash flows. You know, a 5-year bond doesn't wait until year 5 to default, right? Sometimes it defaults on year 1, sometimes it defaults on year 5. And we'll kind of extend it to that one. Oh, forgot to say, on Wednesday, we're going to meet on Zoom. I have to be out of town, but, you know, I have a place. It's called the Panera. I'll put on my earpiece and we'll have the lecture on Zoom. All right? So you can be here if you want to, but you don't need to be. I'll put a link about 15 minutes before class time.